Is Saudi Arabia cornering the gaming market? A couple of weeks ago, Electronic Arts announced that it is planning to go private in a proposed deal valued at about $55 billion in enterprise values, led by Saudi Arabia's public investment fund, Silver Lake, and as well as Affinity Partners. Although, at first glance, the headline price looks a bit rich, when you line it up against what assets are generating assets by EA, the timing of EA's pipeline, the story starts to make more sense. The proposed acquisition values EA at about 7.4 times its expected 2026 revenue. That's almost double what its global competitors are going for. But it is right in line with big deals like Microsoft's acquisition of Activision Blizzard. However, there is logic behind this valuation. It is based on the anticipated boost in profit from EA's major franchises, like the recently released Battlefield 6 and the upcoming EA Sports FC, with the move highlighting Saudi Arabia's growing presence in the global gaming markets. Between Scopely, publishers of Monopoly Go, Niantic, creators of Pokemon Go, and now possibly EA, Saudi Arabia will control roughly 10% of the global gaming market. And that's according to industry blog Game Makers.
Hi everyone, sorry for interrupting, but I'm Jeremy. I'm the producer for Bloomberg Intelligence's YouTube channel. And I just want to bring you a message, as these videos are brought to you by an amazing in-house team right here at Bloomberg. We really believe in bringing you the insights needed to help you understand the finance world. And to help us carry on doing that, subscribing, liking, commenting, sharing really helps us out a lot. All right, with the admin out of the way, let's get you back to the content.
EA, one of the largest publishers in the industry, has a powerhouse of franchise library containing long-running series that generate recurring sales, plus a player base that's spending a larger share of time playing games. When it comes to their franchises, EA owns 4 of the top 20 best-selling game brands globally: EA Sports FC, The Sims, Need for Speed, and Madden NFL. This concentrated intellectual property minimizes risk between major game launches and ensures a steady income through live services. Their engaged player base is another significant asset. Gaming has a strong hold on younger demographics, specifically Gen Alpha and Gen Z and Millennials, who dedicate approximately 1/5 of their daily free time to playing games. However, despite this significant time spent gaming, the industry attracts less than 5% of the $338 billion global ad budget. This gap represents a substantial future monetization opportunity as brands desperately seek to connect with younger consumers, which helps explain the intense interest from large media and tech companies in acquiring gaming assets. EA's core business model has evolved to prioritize live services, which has accounted for about 70% of the overall net bookings in each of the 5 years to fiscal 2025. Net bookings and margins are significantly benefiting from ongoing content for powerhouses like EA Sports FC, Apex Legends, and The Sims. Reduced digital storefront fees, for example, Epic's 12% commission rate, compared to traditionally higher rates at about 30%, could further boost the industry earnings. The market context in 2025 has also been unusually supportive for shooter and sports-led slates. Nintendo switched to a cycle, and a broader lineup from Sony, Microsoft, and others are helping the software market grow an estimated 3 to 4% to roughly $189 billion. Even as Grand Theft Auto 6 slip into 2026, the main constraint when it comes to video game is the development cost. Western AAA development often exceeds $200 million per title to make, with engineer compensation running up in the range of $100,000 to $150,000 in California, compared with about $50,000 to $70,000 in China and around $60,000 to $65,000 in Sweden. Eastern publishers such as Tencent have used that cost advantage to deliver a steadier cadence of live service content. Fresh capital from a buyout could help EA narrow that gap in consistency, especially in mobile. Speculation about EA going private suggested an implied enterprise value to 2026 revenue ratio of 6.7 to 7.4 times. This represents an 80% premium to global peers, but aligns with Take-Two's multiple and the valuation paid for Activision. This premium reflects the enduring nature of EA's franchises and the potential for strong profit performance through its current game slate, as well as live service cycle that we talked about, rather than just current quarter earnings. The takeover timeline accelerated in late September. Reports of a Silver Lake and PIF-led bid valued EA near $50 billion, triggering a reprice debate. Our analysts at Bloomberg Intelligence framed it as high compared with the group, fair compared with Take-Two, and consistent with deals where acquirers paid for leading franchises and installed player bases. 4 key factors have emerged related to the price. First, Battlefield. Second, EA Sports as a genre, EA's financing structure, and the mobile market. First, Battlefield 6 pre-release performance was incredibly strong, breaking Steam engagement records previously held by Call of Duty. With over 600,000 pre-orders and 500,000 peak players, it points to a significant upside. Projections suggest 15 million units sold by March, with an upside path to 20 million units, potentially boosting EA's fiscal 2026 diluted EPS by 10 to 11% above consensus. That possibility that Battlefield outsells Call of Duty for the first time in a decade is not a given, but the setup for this installment is the strongest in years. Second, the sports division. EA Sports FC has successfully maintained its player base after rebranding from FIFA, and a successful Ultimate Team refresh re-engaged over 2 million players. The 2026 entry is expected to benefit significantly from the North American World Cup, with Bloomberg Intelligence estimating a 30 to 40% uplift around the tournament, extending earnings momentum into 2027 fiscal year. Third, the financing structure. The buyout plan involves roughly $36 billion in equity and 18 to 20 billion US dollars in debt, which would push net leverage above 6 times by some measures. However, the credit risk is deemed low due to nearly $2 billion in annual free cash flow, projected to reach $2.3 billion in fiscal 2026-27. That would cover an estimated $1.6 billion annual payment on, say, a $20 billion US dollar debt at an 8% interest rate, according to industry blog GameMakers. A post-EA deal would transition from near net zero leverage to a high-yield profile, which is considered serviceable if game releases and services perform well. And finally, when it comes to mobile, the Saudi connection is practical as well as financial. Savvy Games Group, which owns Scopely, has seen Monopoly Go generate approximately $20 US in revenue per active user, significantly higher than EA Sports FC Mobile at $1 US over the same measuring period. Tighter cooperation could enable EA to leverage Scopely's live service expertise and user acquisition strategies to improve its mobile monetization, which currently lags behind market leaders. Despite these positives, the buyout does carry potential cost. EA's revenue per employee, near $500,000, is lower than competitors like Roblox and Nintendo. This suggests a risk of staff cuts and studio consolidation, particularly in non-sports areas. This risk, common in large buyouts, could impact creative continuity for studios like BioWare or Motif if they are deemed non-core to the objectives of EA's ultimate majority shareholder. So, what does this mean for EA and the gaming industry as a whole? Strategically, 3 key areas stand out: mobile gaming, in-game advertising, and consolidation. In mobile gaming, Scopely's monetization strategies offer a benchmark for EA. By leveraging funding, data, and a robust live service cadence, EA could translate its console success into more consistent mobile revenue, bridging the current per-user revenue gap. This will involve strategic decision on which internal mobile projects to prioritize or discontinue, and how to effectively cross-promote across Sports FC, Apex, and Sim audiences. The impact of potential layoffs and studio consolidations on creative output will need close monitoring during this transition. For in-game advertising, the existing disparity, where games capture 20% of young audiences' leisure time, but less than 5% of ad budgets suggests a significant opportunity for native placements and brand activations within live service ecosystems. Even modest gains in ad share could materially benefit publishers with large, persistent communities. We can expect more structured partnerships around major international events like the World Cup, where EA Soccer's ecosystem offers a natural platform for sponsors and streamers. Consolidation, specifically the potential EA takeover, reflects a broader trend among media and technology companies to secure interactive intellectual property. Disney 1.5 billion investments in Epic, along with Netflix, Amazon, Apple, and others who have pursued gaming assets, highlights a push to deepen engagement and diversify revenue streams. Should EA go private at a premium multiple, it could further validate the valuation of top-tier game IP and stimulate subsequent transactions across publishers and development tools. Operationally, EA Sports strategy remains a core focus. While FC has performed well post-rebrand, a return to FIFA branding has been speculated following the 2022 conclusion of EA's nearly 30-year licensing agreement. Saudi's linked sponsorships around FIFA make a reunion more plausible. Regardless, the 2026 World Cup cycle is likely to draw more players and engagement into the Sports FC ecosystem, favoring live service monetization over new unit sales and shift development priorities towards content that sustains engagement. Regarding hardware and platform cycles, the strength of Switch 2 software, alongside new lineups from Sony and Microsoft, will help the industry absorb the absence of GTA 6 this year. For EA, this means less direct rivalry for the spotlight in 2025, providing space for Battlefield to establish its user base, while EA Sports FC capitalizes on tournament momentum in 2026. This timing allows EA to strategically sequence releases, allocate marketing resources, and align live service beats with calendar peaks. From a financial outlook, for any buyout, debt service is the primary gating factor. While the proposed structure would increase leverage, Bloomberg Intelligence projects annual free cash flow near $2 billion, potentially reaching approximately $2.3 billion across 2026 to 2027 fiscal year. If these projections materialize, EA should have the capacity to invest in content, support live services, and manage interest costs, all while maintaining operational flexibility. The credibility of this financial path hinges on the sell-through of Battlefield 6, the tournament bounce of Sports FC, and the consistent performance of Mobile and Apex. Finally, the premium multiple may be justified by IP quality and a strong near-term slate. Any execution slip could compress that spread. These challenges are not new to investors in the gaming space, but become more acute in a leveraged private setting. The broader industry implications suggest that audience time is the scarcest resource. A limited number of franchises capture the majority of gaming hours, with new IPs accounting for only a small single-digit share. Platform economics may increasingly favor developers that effectively maintain active communities. In this environment, scale, content cadence, and cross-platform reach are crucial competitive advantage. EA's proposed buyout is not happening in a vacuum. It is a response to an audience that now spends a significant slice of leisure time in games, a slate that can put Battlefield back in the conversation against Call of Duty, and a tournament cycle that can energize EA Sports FC. The premium multiple reflects more than a single release year. It prices in a runway where steady live service monetization, potential mobile upgrades, and ad-supported opportunities lift cash generation enough to handle higher leverage. Execution will need to be tight, costs will need to be managed, and design choices will need to reflect a world where regulation, competition, and platform economics are in flux. This deal underscores a larger theme. Games hold youth attention. The ad revenue gap is behind that reality, and the companies that scale communities across platforms are setting the pace.